All right. I'm going to shift gears a little bit. I want to make sure we have a chance to touch on a few more topics. Certainly, there's a lot of talk about what is happening with U.S. debt right now. So our conversations about higher interest rates and what we're earning on our cash also means that when the government borrows money, they have to pay more for the pleasure of borrowing that money. And that's brought up some concern about, growing deficits. Jason, can we hear from you on sort of what we're thinking about, wider deficits as a result of higher interest rates?
Sure. Yep. Definitely topical and hearing more about this as rates rise. So the most recent data as of September 30th showed a U.S. federal deficit of 1.7 trillion over the prevailing 12 months. That's over 7% of U.S. GDP. And for context, this is a record outside of war, recession, or national emergencies like a pandemic. Historically, when deficits top 5% or more of GDP, unemployment is over 7%. Today, we have about a 7.3% deficit to GDP ratio. And yet, as we discussed earlier, unemployment is 3.9%. Yes, it's up a 0.5% off the lows, but it's still at generational lows if you go back over 5 decades. So we have a fully employed economy, yet we have huge deficits. So if you read what the Congressional Budget Office says and projects, they say if we do nothing and if rates stay elevated, then the tab for interest alone as part of the line items in the federal debt or the federal expenses will top 1 trillion in the next couple of years. And that's a big, big, big number. I mean, I remember when they were 200 billion, 250 billion, and we were talking about the level that we're spending on our interest expense. An undeniably higher for longer monetary policy, which we've talked about, has real implications for the cost of servicing that federal debt, just like zero interest rates did in the 2010s up to the pandemic, where we were able to borrow at very low rates. Putting like a numerical layer to this, the average weighted interest rate for the federal debt is currently just under 3%. It was about 1.5% just 14 months ago. So you can see the impact of what the Fed has done and what yields and rates have done over the last year or so. Going forward, more than half of all US Treasury debt will mature over the next 3 years, meaning that the average rate and thus total interest expense is likely to rise further. And so the concern among economists and among market strategists and investors, and really everybody, is that this growing piece of federal outlays toward interest expense can create what's known as crowding out effects in the economy. And it can also create a negative feedback loop in terms of yields going higher as bond investors demand more compensation for ever widening deficits. But to be clear, we don't consider either an imminent risk to stocks or the economy. But it clearly needs a course correction, and we're all watching it very closely.
Yeah, it's gotten to the point where the amount of debt that Treasury issues kind of matters in terms of there's only so much that the market can take. And one of the things, ironically, that has pushed yields lower recently is this sort of arcane document called the Quarterly Refunding Plan that no one used to care about, which is basically the Treasury's announcement to the market of how much 2-year, how much 10-year, how much 30-year debt they're going to issue. And when that came out a couple of weeks ago, actually on the same day as the FOMC, it was sort of less bad than the market feared, in that there was going to be less Treasury debt that had to be absorbed by the market. And that's one of the things that pushed yields lower. So the market is certainly more attuned to exactly how much debt is the US Treasury issuing than it had been in the past.